international outlook. We will have special focus on the effect or aftershock effects of COVID-19 on economies worldwide. And with me today, I have the Chief Economist at ECR Research, Edward Markus, Economics graduate Matthew Farrugia, Investment Strategy Analyst at Bank of Valletta Wealth Management, and Dembik, who is the Head of Macroeconomic Analysis at Saxo Bank. But before I start with the first question, may I remind you all that you can be part of this webinar. You may wish to ask any questions to any of the three speakers we have today. I feel free to do so. It's very easy to access. Just click on the icon at the bottom of your screen. As always, make sure that you keep in line with the subject. Edward, I think the first question is for you. Why is it that economies remain in such bad shape, but markets are and in the US?
Yeah, interesting question. But let me first start with saying that basically there's nothing new on the horizon. We have seen this already from the credit crisis in 2008 on. At that time, the economy was also in a deep hole. We came out of it very slowly. And although the economies were not performing very well, we saw rising stock prices everywhere and for a very long time. Now, what is behind that? I would say keep it simple. We have to first realize that we're coming out of a situation where debts already before the credit crisis in 2008 went through the roof. Then we had a credit crisis because there was too much debt. And how did we get out of the credit crisis? By creating even more debt. We did it in the United States and we did it here in Europe. Why is that so important? That is important because of the crisis we had at that time, we had very strong deflationary forces. And if you combine deflation with very high debt levels, that is a recipe for disaster. So with all means, the central banks had to avoid deflation. And how do you do that? Normally you do that by printing more money, and that money is being used, and the economy starts to pick up in the first place because more borrowing is being done. But in this case, and also now, what we see is that there is already so much debt that it's very difficult to get people so far to pick up more debt. And then what is the reaction of the central banks? They they use more the printing machines and they create a lot more money. More money than the economy can absorb, so the money has to stay somewhere. And what you often see, and also in this case, is that the money flows away to what we call the asset markets. That can be bonds, that can be real estate, and certainly also stocks. And the more the central bank has to do this, the higher stock prices go, but the further away they go from the real underlying economic value. And I'm afraid that we are seeing that now again. If time permits, may I continue a little bit?
Yes, yes, of course. Okay. It's getting interesting.
All right. Yeah, what it makes it so interesting is because we have one example, and that is Japan, where they are already for a much longer time following this kind of policy. But stock prices never went very high. We are still trading around 50% of the highest level in 1990. So it's clear that there can be circumstances that investors don't use all this money to put into stocks and say, no, the outlook is not good enough. I don't buy stocks anymore. And if I look a little bit longer term, then I would say with this policy of printing money and creating more and more debt, we make ourselves more vulnerable for whatever can go wrong or will go wrong. And that already is a reason to buy not too many stocks. But we also have now in the near so can scare investors. And then I'm thinking especially about a second wave, and that especially in the US, there it's more dangerous than here, or more likely, I should say. Also the new elections in the US that are coming, if we get a Democratic president, but also a Democratic Congress, a lot of analysts expect much higher interest, much higher tax rates for all kinds of companies. And what we hear from the medical experts, that is that it's by far not certain that we will get a vaccine that really is going to help a lot. If you combine those things, it's quite possible that, especially in the US, the economy will get a second shock from the coronavirus. And that certainly will be a reason for the stock market to come down. Looking a little bit longer term, I would say more or less whatever is going to happen, it's quite possible we're going to drop 20 or 30% with the stocks. But you can be sure that the central banks then will print even more money, and that will be then a reason for the stock market to go up again. But by the way, also for real estate and more risky bonds.
Matthew, in the first part, Edward mentioned a lot the credit crisis. But the coronavirus crisis has been compared also to the Great Depression in the late 1920s, and obviously it carried on to the 1930s. Do you think these comparisons are really true?
So actually these comparisons, I've heard a lot about them in the media, and they make for good headlines, but actually it's a bit of a pet peeve of mine, because the comparisons, they're not really that fair in terms of numbers, in terms of dramatic negative information, unemployment rates, recessions, things like that. Yes, we can compare because the two periods are obviously negative periods, but there are some very, very important fundamental differences between the two. So for example, let's start with the Great Depression. There's a lot of debate as to why it started in the first place. There was a crash in the stock market, but how does that lead to 10 years between 1929 and 1939? How does that lead to 10 years of economic depression? There's a big debate about that. Also, at the time of the Great Depression, GDP per capita, that's our income, how much we have to basically spend and live. In those days, it was just, in the US, it was just $455. If you get that in today's terms, that's about $9,000. Now, compare that to today, where income is many multiple times higher in the US. And you can see that people in those days suffering through economic hardship had a much worse time of coping. Not to mention the different services and technologies that are available to us that weren't available then to keep productivity afloat, more or less. And I think the biggest difference between the two, forget about the quality of the economy, it's what did the policymakers do to respond to the crisis. So imagine if after this lockdown crisis that we've just been going through, the governments decided and the central banks decided, okay, let me reduce the money supply by 1/3. Let me take away money from the economy instead of putting it back in. Let me sell government bonds instead of actually buying them and increasing the money supply in the economy. Let me actually increase the rate of interest and make it harder for businesses to be able to get loans and actually be able to repay loans. If such policies were to be taken today, that would be basically a disaster. It would be compounding a calamity on a disaster. But that is exactly the opposite. And those are the policies, those are the exact policies that were implemented in the Great Depression. I don't want to take anything away from the Federal Reserve in those days because they were still learning. But we learned from those lessons. We also learned from 2008, policymakers at least. So comparisons between the two, while they sound good when you're writing headlines, there's very, very crucial differences.
Yeah, thanks, Matthew. So the comparison, Christopher, seems to be going around central banks, printing of money, and making cheap making accessible. Maybe you can also amplify a little bit also more about the role of central banks. And if you think, do you think there are any risks of another sovereign debt crisis? Do you think it's on the horizon, or maybe it's too far along?
Well, good afternoon. I think we need to understand that this crisis is mostly about central bank. What do I mean by that is that the first strike actually to face and to mitigate the impact of the coronavirus was central banks stepping in very fast. I think if we take a look at global central banks, they have done a fine job so far in order to mitigate the impact of the crisis. I think that central bank will be the key players still in coming years. So investors need to understand very clearly what is the impact of central bank, what most of the central banks are currently doing. And I think my take is that we are moving slowly into what we call the nationalization of financial markets. What do I mean by that? I simply mean that central banks are becoming market makers in some market segments, especially in the sovereign debt, only talking about developed countries, because in the emerging countries it is still quite different. But due to the fact that central banks are stepping it up strongly on the market, at the end of the day, what they do on the sovereign debt market, they provide the liquidity, they fix the price, and at the end of the day, what they say on the central bank, European Central Bank, Federal Reserve, Bank of England, they have the same thing, they clearly stated the same thing: we will support the economy until the scars of the crisis will last, which means beyond 2020 and probably at least until 2022, 2023. So what does that mean? It is very interesting because in 2012, we had obviously this European sovereign debt crisis due to the increase in public debt. We are facing the same situation with a very sharp increase in public debt, and it will probably increase much more in coming months. But as a matter of fact, it does not matter so much nowadays because central banks are basically absorbing all the new public debt linking to the coronavirus. If you take a look at the European Central Bank, they clearly stated they will buy probably almost 100% of the new public debt raised due to the coronavirus. It is at 70% in the US. It is also at 100% in England. So as a matter of fact, what is very interesting is that we are not facing the same situation of risk of sovereign debt crisis, at least in developed countries, due to the fact that central banks, they will keep being market maker for a very prolonged period of time in the sovereign debt market. So this is not my biggest worry. The situation is slightly different in emerging countries. We have seen that a lot of emerging countries, a dozen of countries, have implemented due to the crisis some quantitative easing. So they buy also sovereign debt assets, but this is not in such a big proportion that it could have a deep impact on the market. I still believe that we can face like sovereign debt crisis, but mostly in emerging market due to the strong exposure to the strong dollar. That's basically what I expect. But for the US, for Europe, I don't think we will be heading towards a new sovereign debt crisis anytime soon.
Thanks, Christopher.
Thank you.
One topical work is recovery. Your opinion, what are the main risks that we are facing recovery? Maybe you can link also to the unemployment levels, or maybe people that they're out of the job, but temporarily. What would be the main risk, especially when we're talking about recovery after all that's happened in the US, in Europe, now we're seeing Latin America, second wave news coming from China, is to some instances even in Germany. So,
well, I think we need to be very humble. We don't know what's going to happen in the coming month. Obviously, there is risk of second wave, so it's extremely complex on investment and especially consumption. If we take a look at some studies from the Federal Reserve, but it is back obviously in the 1918, so the Spanish flu, so it is not completely the same because we are in a very globalized world nowadays. But if we take a look at what happened, the very good studies from the Federal Reserve, they tell you that the impact of pandemic is quite long, and it can have an impact on the economy up to 10 years sometimes. It will change saving behavior, investment behavior. So as at least what we can know so far is that the economy won't get back to normal very fast. It will take probably a lot of years. My biggest worry is not so much about investment, because we know that investment will be postponed. This completely makes sense. But my biggest worry is linked to consumption. If we take the example of China, we have seen that quite soon after the lockdown was lifted, 1 or 2 months after the lockdown was lifted, we have productive capacities are back to normal, more or less. Yeah. But the problem is that consumption remains still very weak in many countries, and especially in China. So this is something that worries me a lot. I think the coronavirus is mostly a demand shock. And as a demand shock, it means that consumption might remain very sluggish in the coming year, the coming month. On the top of that, obviously, you will have higher unemployment. So obviously, people will prefer to save. And we know in Europe, we have usually a very strong propensity to save. So they won't spend so much. They won't consume so much because they would be afraid to lose their job. So I think the recovery will be extremely slow. We have talked about monetary policy, but on the top of that, we need to have fiscal policy to step in. And I think the framework that has been unveiled by Germany, I think it was like 2 or 3 weeks ago, is a kind of good framework in order to stimulate the economy. You have a part for investment, obviously, but you have also a part to stimulate demand. And I think most of the countries, they need to start moving in that direction because demand might remain very weak in the coming months. I read this morning a study regarding some economic sectors in France, and this study stated that in the tourism sector, and they expect that bankruptcy will increase by 80% compared with previous year. So this is very gloomy. As I said, we need to be humble. We don't know so much what's going to happen next, but we know it won't be good, at least. This is quite sure.
Yeah, I agree, especially with regards to the Western world. Not sure about China, because China also have the government that they're already starting building roads, infrastructure, rail tracks, trains, so mining, and Australia cannot even cope with the supply to China. There's so much demand. And then you have Brazil, who's in lockdown, so prices have skyrocketed. But when it comes to the rent, me included, I think confidence, this was a big shock for most of us. So confidence for consumer spending will start trickling in quite slowly. On the other side, I think we've seen banks, especially Goldman and the big banks in the US, they like reviewed their bad debts. At the beginning in April, they were quite heavy. Now it's gone down. Matthew, economic silver lining to this global trauma, this shock that we agree we all have.
So yes, when we go through times which are really hard and unprecedented, it's always very easy to focus on negative things. But if there's something that For example, there's this economist I quite like. He's a bit old, his work is a bit old, but I think it's still very relevant. His name is Albert Hirschman. And basically a lot of his work is about crises and how we deal with crises. And with every crisis, we have two choices. It can be either integrative or disintegrative. Now, those are complicated words, but basically it means how will we react to the crisis? Are we going to take it as a challenge, as an opportunity to improve ourselves, or are we going to focus on the disaster aspect and simply give up on making our lives better? So I believe that most people choose the former. If anything, because we have no choice. We have to try and make ends meet. We have to try and improve our lives in any way possible. So I think we should also bear in mind that, okay, I might be sounding like a cheesy motivational speaker right now, but this point, it's not trivial either. There's very important things that we've seen in history. Many of the great companies, in fact, many great companies were actually founded in times of crisis. So for example, General Electric, that was born in the panic of 1893, with unemployment in the US going up to 43% in some states, 43%. General Motors, for example, it got started in the Knickerbocker or the bankers' panic of 1907, where you had the New York Stock Exchange falling by about 50%. Microsoft, that was founded in the middle of the 1970s recession, which as economists, we quite like that one because it was a combination of economic stagnation, you had no growth, and high inflation. So it's a horrible mix. But that's when Microsoft started. And these are not flukes. We have so many other examples: IBM, Disney, HP, FedEx, Electronic Arts. I could go on. These companies were started in times of crisis. So when I think today, it's hard to think about these things. But I wonder 5, 10, 15 years from now, which answers or problems we probably don't know we have yet, that might change our lives in the future. And one last point, and this is where economists get a bit of a bad reputation, let me say, but we have to understand that there's some positive in bankruptcies and businesses actually failing. It doesn't sound like that, but when a business fails, it frees up resources. Businesses employ people, they employ talent, they employ resources, and they use them up. Inefficient businesses, which are not bailed out, basically, they stop operating for some reason or another. Maybe they had genuine mismanagement. That frees up resources for other companies, and I just mentioned the small companies which are trying to get those resources so that they can grow, so that they can provide solutions for the future. It frees up those resources, and that allows them to grow, the smaller companies. It's a process that we call creative destruction. It's very powerful. It's a very powerful thing that we in free markets and free market systems, we rely on for improvement and economic growth in the future. So yeah, there is some positive. There are those I think are very powerful silver linings.
Yeah. So Matthew, you're quite positive on having new companies maybe coming in of this crisis. Actually, the famous lateral thinker, the Maltese famous lateral thinker, Edward de Bono, always says that the mankind comes up with new ideas, and when your back is basically to the walls, and you need to find solutions. And in some cases, we've seen this happening quite fast in recent weeks, and maybe going forward, it will develop even more. Edward, this is a tricky one about the risk of a second lockdown, which you already mentioned briefly, but maybe you can amplify on the main factors influencing this risk, second lockdown. As I mentioned, we've already seen some cases, especially in China and in some other parts of Europe. I don't know Italy, if it had to happen, if it could be the final piece of the jigsaw that the country will, God knows what can happen. And in line with what Matthew said and Chris said earlier, can we boost really ourselves out of this crisis without maybe too much economic damage?
Well, first of all, if you talk about the second lockdown, why is that so damaging? Basically, what we did everywhere in the world now is say to a lot of workers, please stay home, go away for vacation, and the government will pay for it. How long can you continue with that? I told you already, we're coming out of the situation with debts far too high. And what the government has to do is they have to borrow all that money. So the debts are really skyrocketing at the moment. And we are already over levels where a lot of economists in the past said, if you go over that level, you're asking for a lot of trouble. So a second lockdown would be very bad for the economy, but I'm not so afraid for that here in Europe. If you look to the amount of cases who are infected at the moment and the way we're behaving ourselves here in Europe, it's not so likely that, of course, if people can move more freely, you will see an increase, but that is going to reach the levels we have had a couple of months ago is, in our opinion, very unlikely. We are a lot more afraid for a second lockdown in the US, where politics overtakes scientific evidence, and the economies are opened far too soon. If you allow me, then I would like to add something. If you look to the future, with or without a lockdown, what we are thinking, and Matthew and Christopher, they talk about it already. What we are afraid for is that what the central banks are doing at the moment is they're taking away the most important mechanism that we have in, let's say, in a capitalistic system, and that is prices. Prices are there to allocate in an efficient way capital and labor force. But what the central banks do now is they keep interest rates at 0, while normally they would be at 6, 7, 8% or something like that. And in the case of Italy, probably a lot higher. Now you can do that, but with those very low interest rates, and you did talk about it also, Mark, in how far do you pressure countries like Italy, perhaps also France, to do what they should do to become more competitive and to get a better functioning economy? Every time we save them, and every time they have the feeling, or getting more the feeling, that they don't have to restructure so much, which is politically very popular, that they don't have to do that, and that they continue to get money for nothing. But in the meantime, you weaken your economy looking longer term. And to finish this answer, where do we see all this going to? When there is too much debt, then the government tries to inflate itself out of that via higher inflation. And that's where we think things will go. I'm completely aware of the fact that this year and probably next year, there will be more supply than demand, and that we hardly will get any inflation, and we may be glad if we don't get deflation. But that governments will continue to increase their budget deficit up to the point that we get more inflation, and in that way that they will try to inflate themselves out of this situation. And I think this is a very, very important thing for investors, that yes, money at this moment is flowing, especially to the stock and to the bond market. But in the future, we think a lot more money should go and will go to what we call the inflation hedges.
Thanks, Edward. Questions that we received before this webinar, and even during the webinar, I'm getting in questions I would like you to cover. I will go around each of your speakers. Chris, I'd like to start with you, which is a question which is in line with Edward was saying. Maybe it's a statement here. If we all agree, or you agree, that central banks are actually with all this much liquidity, with an issue of manipulation.
Well, I don't like the word manipulating, but at the end of the day, we are more or less in this kind of situation. As mentioned by Edward, the problem is that central bank intervention, stepping up in the market, is so strong that actually at the end of the day, one of the key mechanisms of capitalism, which is price discovery, where, as I said, I think we need to understand that central banks are market makers. When we take a look at what they are doing on the market, and especially I think an interesting point is in the US. In the US, they even buy high yields. I mean, this is the situation that is completely, it's a nonsense for me, objectively. I mean, I understand that they want to avoid a liquidity crisis. They want to avoid that the market fall down so much. But at the end of the day, this is not a normal situation where you have central banks stepping it so much in the market, not only in the sovereign debt market, but also in many segments, even with ETF. And I think this is not it can last first for quite a long time, I think, because if we take a look at Bank of Japan, it has lasted for quite a long time. Investors need to understand it. And the problem, it will last a long time because exit from this kind of very accommodative monetary policy will be extremely negative for the economy. It could end up, especially in very high inflation. You could end up in very stronger markets. So I think this is a kind of situation where we are postponing the pain. We are avoiding to deal with the real situation, which means to link with what Matthew said, that in period of crisis, this is completely normal, but companies are going bankruptcy, especially the weakest ones, the ones that are not able to innovate or to mitigate the impact of the crisis. This is normal way of capitalism to work. Nowadays, we don't accept that companies can go bankruptcy. We don't accept that there will be unemployment. So it has also a negative impact on the way the economy is working. It avoids pushing up innovation in some economic sectors because you have misallocation of capital. I think we need to understand over the past misallocation of capital. So it will last even at stronger level, I guess, in the coming years, because we all agree here that central banks, they will keep being market player quite a long time. Politically correct, this is kind of manipulating the market, but I am very politically correct, so I won't say that. I would say that this is a situation of becoming market player. But at the end of the day, this is the same thing, I agree.
Yeah, you seem like Donald Trump. Matthew, there's one question concerning Malta. The question is it likely that smaller economies like Malta will bounce back quicker than the other major North European countries?
So with Malta, we know that we're highly dependent on the tourism sector. These past few years, we've also grown dependent, you can say, on the gaming sector. So we're not very diversified in those terms. You also have the financial industry too, which is quite strong in Malta. But those are the two main ones. So in my view, the recovery of the Maltese economy is going to be or broken by the tourism industry and how quickly that recovers. I cannot say if it's going to be quicker than other major economies because they're very different given our dependence on this one industry. But when I think about tourism in Malta, I see that before the crisis, we had a bit of a bottleneck problem. We had a lot of demand, and our supply being what it was, a small island, lots of projects, lots of construction projects going on, that was a sign that we had a bottleneck issue. So going forward, I think that if our industry leaders are capable enough, which I'm sure they are, we should be able to capitalize on certain advantages that we have specifically in Malta, maybe capture tourist flows at the expense of other exotic locations that tourists might shy away from in the near term. So this means what I'm saying is that our comparative attractiveness as a location compared to a place like Thailand, for example, for Western tourists, that has increased because they're spending less. We're not going to go on these big lavish holidays. So maybe setting your sights a bit lower, you go to Malta, for example. And fortunately and unfortunately, if we can capture just a small portion of those tourists who decide to go to shy away from exotic locations, if we can capture just a small part of that, for us, being a small economy, that's our advantage. It's proportionately large, so it will have a big impact. So from that perspective, yes, we might maybe bounce back a bit earlier, but again, compared to other larger economies which are more diversified and also not who are connected geographically, we are not. We are an island. It might be a bit of a challenge. But like I said before as well, industry leaders, they have to recognize the opportunities, market in the right way, and yeah, it can be possible.
It could be possible. Yeah. Edward, one other question we have from the participant is your opinion on the outlook for banks and their role in the economy post-COVID. Not central banks now, banks.
No, that's clear. Well, I think the banks may be very grateful to the European Central Bank because they have now taken all kinds of measures that basically boils down to giving money to the banks. They can borrow at the central bank at a lower rate than that they can place money at the central bank. So that's basically subsidizing the banks in Europe. And if the banks go one step further and they buy bonds or something like that, then they make a very nice margin at the moment. Well, why does the central bank does this? Because in the United States, about 75 to 80% of all the borrowing is going via the capital markets. And it's only about 20-25% via the banks. Here in Europe, it's exactly the opposite. By far, the most borrowing here is done via the banks. And we are in a very, not very, but in a difficult situation here in Europe that most of the European banks hardly fulfill the capital requirements that the central bank has posed on them. And if they don't have enough capital, they cannot loan out a lot of money. And that would be devastating for the economy. Don't forget that at the moment, about 2/3 of our growth is coming from borrowing. It's only 1/3 that we really earn. And if the banks don't loan out money, that of course is very bad for the economy. So what the central bank is doing at the moment is really subsidizing all the European banks, make sure that they get enough capital so that they can freely loan out money. So, and I must say, if I look to the future of the European economy, especially for this reason of what is being done at the banks at the moment, we are not that negative. I see more problems in the United States than over here in Europe.
Thanks, Edward. Chris, question for you. Following my earlier comments about Italy, about coronavirus and the impact in the country, do you think that the euro will survive if it gets hit with a second second wave?
Well, I think we know how to deal with the second wave. We know it quite well, and that's the positive part. When I see that a lot of countries have implemented the right rule, except for the UK, which is still facing the hard situation in terms of health crisis. But if you look around, most of European countries are handling quite well the health crisis. So in the hypothesis that we face a second wave, but we are still not yet at that point, I think that most of European economies and politicians, they know how to handle the situation. There will be still one question, big question will be that depending of the risk, obviously, should we put a new lockdown or partial lockdown on the economy? If you take a look at a lot of countries currently, they consider that we can have localized lockdown in some which has happened recently in China, but we don't want to lock down the economy again, and which makes sense at one point, because obviously the impact of the crisis in the second quarter will be extremely negative in most of European economies. But if we implement again the same kind of very strict lockdown, I think that I don't know how central banks and governments will be able to deal with the situation. So what we need to understand is that this is still very uncertain what's going to happen. I think the stock market has understood quite well that there is this risk of second wave. So this is positive for investors, I would say. The risk has been priced already a bit in the market. But in terms of economic situation, I mean, this is bright clear in my view that we cannot afford to have again a very strict lockdown. I mean, the economy won't survive. And this is, you see that, I think we will start to see very well where the economy is moving towards from September. Because from September, a lot of companies, at least the weakest ones, they will start to fire people. They will lower costs quite a lot because they will understand that the situation is not good. We will see if demand will remain slow or if it will increase. So maybe we could have also positive news, we never know. So we need to be patient. I think everything will be set up at least on the economic part and probably also regarding the health crisis from September, because I see that some scientists, they consider that the second wave could happen only in September, October, during autumn, like the Spanish flu. We don't know so well, but you see, this is the key period for economic situation and health crisis.
Matthew, another question from the participants. It was reported by government, here we're talking about Malta, that deposits spiked during COVID in a near zero interest rate environment. Why do you think this was the case? How does this affect the ability of the Maltese economy to return to pre-COVID levels? And by when do you expect Malta to return to this level? I think even globally, we've seen the US, they saved more record. They're saving on a record level never seen before. So I think it's happening all over. Maybe if you want to give it a global twist, or maybe more on the local economy.
So the phenomenon being referred to there is quite well known to economists. We call it the paradox of thrift. It was first outlined by a famous economist called Keynes. You might have heard of him. People might have heard of him. Very famous. Basically, what it is that when times turn tough, your instinct is to save. Maybe a bit too late, because you think times are tough, I'd better save now. When in reality, to get the economy going again, and I'm not saying I agree with this, but it's the rationale. When times are tough, you need to do the exact opposite. That's why it's the paradox. Instinctively, you want to save more because I don't know what's going to happen. There's so much uncertainty. But in reality, if you want to get back to economic growth, now is the best time. It's the crucial time to spend, increase consumption. Then you have what they call the multiplier effects, etc., and eventually economic growth goes up. So that's why I think deposit spiked, even though we've got a near zero interest rate environment in Malta, because abroad you've got negative rates too. So, and I think the second part related to how it affects the ability of
return back to normal. How fast can the economy recover?
Okay, so we've seen governments really pushing this consumption, and as Edward said, manipulation of financial markets. Now you have manipulation of actually the real economy. So governments are really pushing, and in Malta we just got the vouchers. I just got a check today from the government, so that's good, to push for consumption. Go out, go spend, go to restaurants, go buy the steak. No more pastizzi, not the cheap stuff. Go get the expensive stuff. Let's get things moving again. So that will definitely push things along. But I give the impression that I'm all for all this intervention. But me, the economist me, says no, it's not good. We need to suffer a little. We need to rearrange things organically. The investor says, okay, I don't really care if there's a bubble. It's as long as there's prices going up, I can exit when I see inflation going up. I am a step ahead. But the economist says, not so good. So this will help us return to a level of economic growth earlier. But how healthy is that growth going to be? This is it's a key question. And it will take, I think, 10 webinars to answer fully.
Maybe you can answer this one. Can you explain in more detail what you mean by inflation hedges?
So inflation hedge, when we say hedge, we mean
more
protection.
More textbook stuff.
So how are we going to protect against inflation? So let's say I have my money and I just deposit in my bank account, and inflation is going up. I'm not earning any interest, so the value of my money, the goods I can buy with the money, it's falling. Because inflation, the prices of goods are going up, but your money is just, your cash is just staying the same. So what you want is something that increases in value along with inflation. So instead of inflation decreasing the value of your money, it actually goes up with it. So we have things like inflation-linked bonds, whose returns are linked to the inflation index. We've got things like gold, that's an inflation hedge. So when people see that inflation is going up and they see that the value of money is going down because that's inflation, they turn to stores of value, means of exchange, which are not fiat currency, not cash, like gold. It's the classic means of exchange that people have always gone to. For some reason, it's psychological. We just like the yellow shiny stuff. There's no real reason why, but it's been that way for thousands of years. And if something has been around for thousands of years, then we have a very deep relationship with it, and it's likelier to stay.
Yeah. Edward, one other question from the panel is from the participants. Will an early vaccine, when and if, will it really trigger confidence? We'll be talking about loss of confidence and demand. And are there any projections as to how this would correlate with national performance in Europe? So this early vaccine may be thematic areas like leisure, like oil and gas, metals, and what's the impact on such sectors?
Yeah. Let's assume we can invent a vaccine that works in the same way, let's say, as it does against the flu.
Yeah.
Then there is not so much reason for people to stay to stay scared about the coronavirus. So if we would get something like that, or we're talking about a vaccine, but it may also be medicines, then I think we will quite quickly return to the old situation. People will start to get confidence very quickly again. The problem is that if we talk to the experts, they all tell us that the likelihood that we will get something like that very soon is not high. Yes, we will get a vaccine, that is more or less for sure, but probably it will not do a lot more than that you don't die anymore from corona, or that it only works in, let's say, 60, 70% of the cases. If that's the case, then people will stay quite, yeah, how do you call that? They will stay afraid, so that will hurt spending. Now, it will be an improvement from where we are now, so in that sense it's good, but it doesn't mean that we go back to the old situation then. That will take a lot longer. Probably in the end, we will learn to live with the virus. But I think in what is the most likely scenario is that we will get some medicines, we will get some kinds of vaccines that will reasonably work, but it's not that the coronavirus is over then. And that will still hurt the economy a little bit, because you still will have people that don't like to go to mass meetings, football stadiums, all the theaters, and so on. So it will do some damage to the economy, but probably not too much. Where we are more afraid for is if you talk to the longer term about all these high debt levels, that will hurt the economy, in our opinion, more than the coronavirus, if I look longer term.
Very good. Yeah, we're coming to the end, so I'll give you some questions. Maybe you have a minute each. I start with Christopher. One of the questions is cash still the king?
Not in my view. I think that we need to, in the very long term, we need to think about the inflation edge, as Matthew mentioned, and I guess gold could perform well in the long term, paper or physical gold. But in the short term, medium term, I'm still very bullish on the equity markets. I mean, I think there is this disconnection with the real economy that is kind of deep. And what I think matters the most with the equity market nowadays is central bank liquidity. And if you try to assess the evolution of central bank liquidity, you have seen that over the past weeks, over the past month, it has increased quite a lot, and it is very likely that it will keep increasing a lot in the coming months. So in my view, I think that we should not avoid investing on the equity market because I think you still have very strong and very good return. And in the long run, you might increase your exposure to gold, for instance, in order to have an inflation edge.
Okay, Matthew, 1 minute, another question. What are the best investment solutions for parking or investing one's cash during this period? So we spoke about excessive deposits, and people are waiting. There is no confidence. So maybe you can give some insight on the best investment solutions.
So it's obviously when you come to questions like that, putting your money where your mouth is, it's very hard. But my outlook, the way I see it, like I mentioned before, this massive influx of liquidity, and if I had to show you a chart of the money supply, it's honestly scary. You'd see the graph go up, and then in the last bit, it's basically shot up. It's unprecedented. It's honestly, it's a bit crazy how much the money supply is increasing. So all that liquidity, it has to go somewhere. We've seen, even if you want to take an interesting point, perhaps, if you think about inequality, you have the very top, they have a lot and a lot of wealth. That wealth can't be consumed. It has to be invested. There are only so many yachts they can buy and so many supercars you can buy. Eventually, you have to go to your financial advisor and you have to invest that money, either that or just save it. That's going to push markets up. It's going to keep pushing prices up. There's that huge pressure of liquidity. And even this money that's going into the pockets of Main Street, eventually it will flow back to companies. And when it flows back to companies, you can imagine where it goes. And this is a point that I think a French economist actually, he raised, Thomas Piketty, very famous. He wasn't raising this point about inflation, it's just wealth inequality, capital inequality. The people with a lot of capital, they basically have much more. So there's very little risk of that liquidity going into Main Street, staying in Main Street, and pushing up inflation. And this is also related, one last thing, to modern monetary theory, where we're basically pushing, yeah, we can just keep printing money, party forever, unless inflation goes up, you know. So markets, yeah. I'm positive on the markets because, yeah.
So preference is on equities, maybe. Edward, this most probably will be our last question. How can investors, maybe even us, make sense of all this market that's going on?
By realizing that economy is not markets at the moment. It all comes down to the money creation and what is happening with that. But again, I come back to the point I made earlier. It's not a one-on-one relation. It's not so that if you print more and more money, that automatically prices of assets go up. We have this example of Japan that it does not happen. And so we are looking now to the near future. We are afraid that people will start to get disappointed, especially about what's happening in the US. We are very afraid, not very afraid, we are afraid for political unrest in the US, for the elections, for a second wave. I think there will be some disappointment how fast the economy will grow from the fourth quarter on. So we are inclined to think that the stock prices in the US, and that will take the rest of the world with it probably, will go down on balance, during the next couple of months, if not quarters. And thereafter, I agree with the former speakers, probably because of all the money printing, the stock market will go up again. Yeah. One final point where we did not discuss, but I think is very important. We did talk already about inflation hedges, which we think are important for the long term, and then especially gold. But there's something else with gold. we have more and more the feeling that the dollar, which has been strong now for a couple of years, will slowly start to weaken in the future. We are quite negative about what is happening in the US. I think I made that clear. We think, relatively speaking, we are doing better here in Europe. And we would not be surprised to see in, let's say, in 1 year or something like that, euro dollar trading above 120.
Yeah.
And that would be an extra plus for gold.
Yeah. So thank you. So we spoke about central bank's intervention during this hour, about inflation, maybe Italy, the euro, about confidence coming back, second lockdown, what would be the risk. I think we covered most topics. We have to end there. Thank you, Edward, Matthew, Christopher, for being on this webinar today. I thank you all. You were really quite explained and very detailed, and at some point. And thank you all to those who joined us, who asked the questions. Hope we covered most of your questions. We couldn't answer them all, and I'm sorry about that. May I remind you that before you make any financial decisions, you have to study all the facts, get in touch with your financial intermediary. We here at Bank of Valletta, you can contact any Bank of Valletta branch, investment center, or wealth management, or even if you like, you can before visit our website, www.bov.com. Thank you, and bye to the next one.